So thanks everybody for joining today. Hope everybody had an enjoyable weekend. I know that in my life, the most exciting part of the day has become deciding what's for dinner. And so there's not very much excitement, but there has been lots of time to focus on markets. And I know certainly our investment team has been very, very focused in going through this last period of time. Just quickly, I thought maybe today we could touch on sort of what we see going on, what we have been doing in the portfolios, and where we see opportunity going forward. Because ultimately, I do believe that there is a generational opportunity coming out of this situation, as difficult as the health crisis is. Now, just to be clear, there's lots of approaches, and as you know, in our approach, I think there's three things we're really always focused on. First of all, none of you need us to generate a return that is highly correlated to the S&P. Our job is to target. And so we're really focused on trying to get through a bunch of different types of market conditions and specifically try to identify market leadership. And that could be sector-based, it could be geographically based, theme-based certainly. Ideally, what we're trying to do is identify structural themes that are being revalued in the current environment. We have to always be looking for change, new leadership to emerge, and old leadership to lose its steam. And of course, in the last while, have had an ability to play some defense. And that might mean leaving the market entirely. It may mean leaving big parts of the market. Right now, it means avoiding some very specific groups. But ultimately trying to be kind of tactical. Now, as you know, we've believed we've been in a structural bull market in stocks, and we'll talk a little bit about that today. But whether you're in a structural bull market or a structural bear market, there are big problems that come along, like the '87 crash and the bull market of the '80s, or certainly 2008 or 1973-74, where you have to be able to play some defense. And so we really very strongly believe that you have to pick your spots. And that means that probably asset allocation in the portfolios that we run has to change quite dramatically over time. Now, the income mandate that we are running in the UCITS fund, of course, is based off the mandate that we've been running since 2000 onshore in North America. And it's been one that's worked quite well over lots of rolling periods, and not specifically because we were knocking it out of the park at any moment in time, but because we were pretty good at not getting hurt in big drawdowns. And, if you go through time since 2000, we're down kind of 10% in 2008. We were down a small snip in 2015. We were down some in 2018, but in general, very good at not getting hit. And we've used the process that we have exclusively to make our decisions and to stay away from having an opinion as to what should happen. Really, I think that our job is to understand what is happening. And so we use our top-down breadth-based model to try and drill down through all the investable universes we could focus in. And those are sectors and themes and geographic regions and different parts of the capital stack, frankly, corporate preferreds, converts, and certainly common shares, to try to identify pockets that are seeing that new inflows, or in our case, where breadth is expanding, where we know money is getting put to work. We try to then populate or express our view using our bottom-up security selection model, which is aimed at finding securities with fundamental characteristics that are good but getting better or showing acceleration. In the case of the UCITS fund, trying to find securities with an improving ability to pay us. And certainly in a world like we're in right now, that is going to be very important. As you've all seen, there've been lots of dividend cuts. And there's likely to be some balance sheet impairments due to cash flows. And it's going to be very important to sort the good from the bad. And then, of course, we manage that inventory of securities that meet our tests and groups that are showing expanding breadth with stop losses to make sure that if something isn't behaving the way that it should be acting, it winds up on the sideline. So as you can imagine, we wound up with lots of cash going through the sell-off. The top-down model, of course, as we talked about before, is about finding groups that have become under-owned where there is expanding breadth, which means there's money getting put to work, and then staying in those groups so long as breadth continues to be supportive, because there's no bear markets ever happen while breadth was expanding. When breadth starts to contract, often It will not be obvious in the leading securities within those groups. This is the weaklings falling away first. But that tells us we have to be a little cautious because the tide is going out. And that might be at the market level, it might be at the sector level, it might be at the thematic level. And then of course, that means that we might have to hold some cash. So ultimately what this thing has done is over time has enabled us to have quite low daily vol, quite low, certainly quarterly vol against the worst quarters in the market, and manage the big drawdowns quite well. So as you know, in the last call that we did, we talked about this waterfall decline that we went through, all in about 34% from top to bottom in the S&P, and where things might go. We noted that it was an exceedingly sharp decline and difficult to manage. I was pleased with the fact that we gave up in general about 50% of the decline in our various mandates. There's our equity strategy onshore versus S&P and TSX. There's our income pool. There's our balance strategy. All of them went through the decline with fairly muted volatility. And then of course, we've had to move forward from there. If we take the UCITS fund to today, again, about a half of the decline going through, this is against the S&P, the Stocks 50, the US Dividend Aristocrats universe, and then the All World Index. And so versus S&P to date, we're a little ahead of the S&P, but with about a half of the volatility going through the decline. And certainly well ahead of the European markets in US dollars, and certainly well ahead of the Dividend Aristocrats universe or the All World Index. So my view has been from the beginning, try to generate a return with a risk characteristic people can live with. Here is, since 2016, the UCITS fund in white, volatility through each of the volatility spikes versus the S&P. And so on the bottom panel here are the deviations, and virtually all of them have been deviations to the downside, meaning less volatility. In the most recent drawdown, of course, pretty happy with that. And that really is in line with what's happened in our onshore products since 2010. Again, much lower spikes in volatility, because ultimately we need to know our clients can stick with us as we go through these drawdowns. They don't get to the point where they need to be shaken out, and that we do provide some lower vol going through the drawdowns. So on the last call, we talked about the fact that when you have a waterfall decline, in this case it was 1987, historically what you get coming out of it is a period where the market has to do some work. So you're going to get a sharp bounce, and then you're going to get some choppiness. And if you've been in a structural bull market, when you got a waterfall decline, you wound up having ultimately the opportunity of a generation. In the case of 1987, market rallied sharply for 2 years following. Once it did its work, and it rallied about 66% over the next 2 years or 100 weeks. If you took all of the waterfall declines going back to the 1920s, in all cases you had sharp rallies, and in virtually all cases you had some consolidation to do along the way. So our view had been to try and take advantage of the bounce, not to push too much money into the market, and maintain flexibility, because when the market does pull back, you get some clarity around where the leadership is. So in an initial technical bounce off the bottom, everything will rally, things that people want to own, and also things that need to be covered from a short perspective. And then ultimately, when you get a period of sloppiness, those things that we're short covering or that are not well suited to the environment going forward are going to have difficulty, and the leaders are going to maintain their strength and maybe build on it. And that's what we want to ultimately see. So really, you know, as my friend Jonathan Golub at Credit Suisse liked to say, you know, there are a number of phases in going through this process. You have the initial panic and rapid decline as people realize that there's an issue. You have ultimately a second phase where there is some forced liquidation, where everything gets sold. A third phase is you get a technical bounce in every case off lows. In this case, technical bounce is 38%, or about a 1/3 retracement. You had some noise, and then you had a second phase driven by fiscal stimulus and central bank intervention, and ultimately a slowdown, in this case, in the COVID virus. And then you're going to start to do some work. So the market now has been chopping sideways for about 10 days. And we've been in a range between 27.25 on the S&P and 28.79. This initial lift, which had a very clear channel, has ultimately come down out of that channel for now. And if we were to take the leadership groups, they have all maintained their channel they've been in since the bottom. And some of the groups that are maybe not well suited to what we're headed into have also come down out of their channel. So the market is going through now a sorting process. And within these groups, of course, there are some companies better suited than others. And the obvious example would be in retail, where Walmart and Amazon clearly well suited, and other retailers that clearly are not well suited. So our view has been over the last 2.5 weeks that we are into now a sorting phase, and this is going to probably last some period of time. Now, when we talked about the possibilities, we said there's 3 possibilities off the lows. One is a V-shaped bottom, and I continue to believe that that is less likely. The second is a sharp rally and a period of time where the market does some work, and that ultimately then out of a consolidation period, leadership evolves and the market moves on. And of course, the third possibility is the market selling off back to the lows and breaking the lows because there's more damage or more complicated circumstances than we have imagined. Maybe it goes on longer and there are solvency issues based on cash flow, and that you wind up in a severe bear market. I think that is less likely. Less likely because the waterfall event started in a structural bull market. Less likely because the Fed and other central banks have been very aggressive, probably more aggressive than in any situation in the past. But with that remains to be seen. We have to go step by step. So our first job was to manage a vol on the way down. I'm happy that we did that. The second is to watch for what rallies. And then third, let the market do its work and let leadership emerge and maintain a low volatility until ultimately we resolve higher or lower. So here's what my work says today. I've shown you all this breadth model in the past. This is the NYSE we're looking at. This is breadth back to 1997. I've got this back to 1954. The first time I came to Geneva was in the first week of February 2016. Breadth in the NYSE had been declining and had just reversed in the second week of February, the second month, giving us an entry point where many felt there wasn't one. We had another low in December of 18, and we saw this low most recently on the 23rd of March. So breadth tends to lead price. New stocks breaking out, increasing the percentage of stocks in uptrends is positive. And when those underneath the surface start to break down, that tells us that it could wash through other stocks. So I just wanted to highlight the fact that we got to a low of 6% at the end of March. And you have to go back to 2008 to have had a reading that was lower. And in October of 2008, after the first major sell-off from September to October, breadth in the NYSE hit 4%. That's the lowest reading in history. Now look what happened. The market turned at the end of October, beginning of November, and breadth rallied through until January of 2009. That was the first major rally. But then from just under 70%, breadth started to deteriorate again. Now between January and March, of course, the S&P sold off to a low of 666, a much lower low than it had been in October. But to be clear, many fewer stocks revisited their lows in the second sell-off. By the time we bottomed in March, actually, many groups never came close to revisiting their lows. The natural leadership had emerged. The natural losers were obvious, the financials, who went to much lower lows. And then we got the secondary low in the market at the end of March 2009. So where we are today, we bottomed at the end of March. Breadth has expanded sharply. We got to 66%. But as of 8 days ago, breadth started to weaken again. Now, there's some very clear leadership in the market, and there's some winning stocks. There's lots of things that are doing well, but there's also some things underneath the surface not so good. Now, that's the NYSE. NYSE has been the strongest of all the indices globally. European breadth bottomed the same way in March, much like it did actually in October of 2011. Rallied through until about a week ago, and then breadth started to weaken again. Now, that may be a short-lived issue. It may reverse right back up again, and I watch that every day. But as it is, around the world, Latin American breadth has reversed down. Asian breadth is within 0.5% of reversing down. Indian breadth has reversed down. Japanese breadth is weak. So this is something that causes me to want to maintain flexibility, to maintain some dry powder. Now here's the S&P 500 point and figure chart, selling off in a series of lower lows and lower highs through February into the end of March. The first phase of the rally, a pullback. The second phase driven by stimulus and COVID getting better, higher highs. But then about 10 days ago, we had a lower low, and we've rallied to a lower high. We rallied right into downward resistance. Now, can that reverse up and break out? Absolutely. And I hope that it does. The same way I hope that breadth reverse back up. But these things tell me that we have to be a little bit cautious. And like other times in history, we are likely to have some testing. We're headed into the biggest week of earnings in the S&P this week. And yes, we're seeing some geographic regions start to reopen. The devil will be in the details. I'm going to guess that it will be somewhat more complicated and more cumbersome than people expect. And that could be cause for some more sorting, good from bad. This is a chart from Goldman Sachs that looks at the average percent below the 52-week high for the S&P less the median stock. So in other words, the lower this number is, the narrower the market is. So despite the fact we've had a 30% rally, breadth based on this measure is very low. Much like it was in 2008, much like it was in 2015, leading into that second sell-off. This is a comparison of the first 23 days of the rally from December 2018 and March 2020. As we know, 2018 gave a breadth thrust, which was a very heavy 10-day advanced decline line that had signaled historically significant rallies in the past. And of course, that's what we got. In the 23 days we've just been through, nowhere near that kind of breadth thrust. So the upside downside volume, while it has been decent, nowhere near what we've had at other major lows. Again, a cause for some caution. Now I use 4 short-term indicators, which I think are important to track. One of them is the percentage of stocks in the NYSE trading above its 150-day moving average. Of course, 150-day or 200-day moving average is a great measure of long-term trend. So I want to point out that as of this morning, only 12% of stocks are trading above their 150-day moving average. In other words, 88% of stocks are in downtrends as defined by whether they're trading above or below their 150-day moving averages. And in almost all cases, those 150-day moving averages are declining. So that tells me the market has work to do. The percent of stocks trading above their 50-day moving average is 24%. It's improving, and I think that's great. But again, that means 76% of stocks are below their 50-day moving average, another measure of short-term trend. The market has more work to do. Now, the clear leadership is the NASDAQ 100. Different than the S&P, it has maintained its upward channel off the lows. And of course, that's probably because the most important stocks in the market, the 5 big concentrated names, are leading this indice. Underneath the surface, not quite as good, but definitely this is the right neighborhood. But again, if you take the NASDAQ against the NASDAQ advanced decline line, the index is deviating away from the advanced decline line. So percent of stocks above the 200-day in the NASDAQ is higher. It's over 40%, and that's great. But it really isn't picking up over the last 5 or 6 days. So we need to see that expand. So let's get down to positioning. The Tactical Income Fund is not the S&P 500. It is a fund that can hold any number of income-producing securities with a goal to generate a strong equity income return. It can hold fixed income, it can hold preferreds, it can hold dividend-paying common stocks. It could be in bond proxies if we want to be really cautious. It could be in dividend growth stocks if we're feeling better about economic environment and if that's where the leadership is. Right now, it is split into 3 camps. Based on the fact that we want to have some flexibility and our models are not all positive, we have some fixed income, short-term governments, and some corporates. And that is essentially cash, what we could use to move into more concentrated leadership themes as they emerge. The second theme is that we do have some more defensive sectors. But to be clear, the holdings we have in those defensive sectors look quite unlike their underlying groups. Like, for instance, a couple of the utilities that we have do not look like the utilities group. They're much higher growth and much better dividend growth. The REIT holdings that we have look unlike the REITs, much higher dividend growth. And then we have the secular growth names that are really well structured for the current environment. And in fact, in most cases, their themes are being accelerated by this healthcare crisis. So names would be an example, would be Walmart. So let me just run through a few of these names, and you'll see that the holdings are in the presentation for the recording. To me, healthcare is a very clear leadership theme. This is relative price strength versus the S&P. It's been rising sharply since the beginning of the year. We're effectively at a relative strength new high versus the market. And then there are underlying holdings within the group that really stand out, like Abbott Labs, for obvious reasons with their testing. Technology continues to lead, steadily rising relative strength, clear leadership before the sell-off, clear leadership coming out. Within the group, there are semiconductor names, there are software names. Microsoft is a great example, new relative strength high. Apple is another name. Activision Blizzard is another name that we own in the software, in the gaming software group. In the REITs, we have some high growth REITs that have nothing to do with commercial or retail REITs, in particular, this American Tower, which owns cell towers. If anything, we're accelerating the use of mobile data, and 5G is going to continue to roll out. In the consumer, if you're to take an equal weight of the consumer discretionary sector, it continues to look sloppy. If you look at the leading names like Amazon, Walmart, and Costco, they've made new highs since the sell-off, and clear winners coming out of this environment. There's Activision Blizzard. In the utilities, we own Nextera, and Nextera is the largest utility focused on renewables. So based in Florida, very high degree of wind and solar, and clearly winning against the group for outperforming the sector. And then finally, precious metals, which we've been talking about through the course of the year. I'm not a gold bug, but very clear leadership here, and I guess both with defensive characteristics and stores of value. Newmont, Franco-Nevada, Barrick Gold, all within our group, all have great potential for dividend growth. And I frankly think that they can go a lot higher. While price of gold is trading virtually at all-time highs, the XAU index is trading at less than half of its all-time high. So it is becoming a little bit more heavily owned and certainly could pull back at any time. But again, a pretty clear leadership theme. It's about 9% of the underlying portfolio. Things that we don't own: financials, recently hitting relative strength new lows. That's US regional banks and European financials. On a weekly chart, back to 2013, this is a group that we are avoiding. Within financials, we own S&P Global, we own BlackRock, both of them winning from specific themes. And we have very little by way of industrials. Clearly, industrials are being hurt by Boeing and any kind of company selling machinery into the energy space. Again, we have very little, but we have virtually nothing by way of energy. But as you can see, after the initial bounce, and this is the same for these groups I've just talked about, all of them have broken down out of these upward channels. So the market is doing its sorting. So I think that this market has tremendous opportunity as we work our way through this process. There are going to be some very clear winners and some very clear losers. I think being targeted is a great opportunity. I think the portfolio has lots of flexibility. We have cash that we can continue to deploy. We have leadership themes that we can focus in. But again, we want to see the market do more work. The one thing I want to make sure I say, though, is that I believe we continue to be in a structural bull market. After exiting the 13-year period where the S&P made no progress, S&P has been able to hold this long-term trend line. I think that's a positive, and very clearly the NASDAQ has been the strongest part of the world. None of the other world markets look the same as these two. So that's why we're focusing in the US. The very long-term opportunity, of course, is what I've been talking about for 2 years, which is going through the generational low in interest rates, which I believe we are going through. And this is probably the event that will put the punctuation on the low in generational yields. We know that money has been pouring into bonds and is crowded there. We know that money has been pouring out of equities. And there, as of today, is more cash than at any time in history sitting in money funds and on the sidelines. We know positioning in portfolios is quite defensive. Mutual funds have higher cash weights now than at any time since 2008. And that ultimately they will slowly start to work their way back as things get better. But if we go back and look at that period between 1966 and 82, where rates did start to bottom and go higher, we know that instead of a 1-to-1 return for stocks versus bonds, as we've had since 1980, 1981, you had a 5-for-1 stocks versus bond result as you came out of that period. And if you got to dividend growth, as opposed to fixed income or credit, the returns were way better. And this is what I think the opportunity is coming out. It's going to require a lot of work to make sure that we don't get caught with any names that have any risk of a dividend cut. We know that that takes 2 to 3 years to work its way through the market as the shareholders turn over in the case of a dividend cut. We have not been caught with a dividend cut in 5 years. I think it's unlikely. I think that the strategy worked really well ultimately when you start to see rates work their way higher. And I can't tell you when that's going to be, but it's working okay as we sit. But in the end, if things get more difficult, we have a defensive bent to begin with, and we're willing to get more defensive. As we sit right now, we have a small hedge in the portfolio because we do think that the market has some more work to do. And that should protect us against a major decline if we have another leg down. I can't tell you for sure where things are going, but I would say our work does a pretty good job at sniffing out change. And as it is right now, I think it makes sense just to trim our sails a little bit, to be a little bit cautious, to let some more time pass, let more information work its way into the market. This weekend, next will be big ones for corporate news, and we can continue to adjust the portfolio accordingly. Thanks very much.